Welcome back. Our next guest is focused on stocks that pay dividends, and he's got 3 dividend stocks that he likes that he'll share with us in just a couple of minutes. Joining me in studio is Oliver Shao, Director and Portfolio Manager of Global Dividends at IA Global Asset Management. Thanks for coming in, Oliver.
Good to be here.
Let's talk about your macro outlook. I've seen in some recent commentary that you think we are quite likely still in the early stages of a bull run, but I think current valuations make you cautious. Is that correct?
What's that phrase, Paul? Cautiously optimistic.
Yes.
There's no denying that the market has been doing very well, but I think if we step back, take an outside view, normal bull markets last 5.5 years. We're around 2 in. So obviously, within that, there's pockets of the market that has done exceptionally well, and mostly driven by earnings, call it the Meg 7, right? So we're very vigilant in trying to figure out whether there's going to be potential earnings risk in the Meg 7 as our starting point into the year. But at the same time, we are interested in pockets of the markets, namely, let's say, transport, some parts of AI beneficiaries, and companies in general that are able to take price regardless of whether the end market is weak.
One stock you like is Alimentation Couche-Tard, the big Canadian convenience store company. Has not had a great 2024.
No.
You think the setup is good for this one?
That's right. So there's been 2, I think, headwinds for this company, one of which is the low-income consumer. And the second one is people are waiting for them potentially doing you might say, a small deal trying to buy out 7 & 9 Japan. So in regards to the first one, we think that's the weakness in the low-income consumer is being priced into estimates today. And frankly, if we think about what the company itself has guided to, the $10 billion in EBITDA in 2028, we don't think they can achieve that so far, but consensus also doesn't believe that. So we don't think they need to hit it for the stock to work. Now, secondly, when we look at the underlyings of the business, other than the low-income consumer weakness, some pockets of what they're trying to do in terms of getting better at fresh food, in terms of thirst, those are working if we look at the incremental data points that are coming out. Now, lastly, when we talk about the deal that's potentially going to be done, yes, if it goes through, there's going to be a big equity check coming. But at the same time, we're confident that management has historically been able to stay disciplined in their capital allocation. And so if it doesn't, then we're perfectly happy owning the business without an acquisition of 7 & 9.
Through the company's history and the stock's history, there have been several times when the company's made a big acquisition and the stock has rallied in a big way after for a good year or more after that.
Right.
The market has a great deal of confidence in this company's ability to execute on mergers. And you mentioned 7 & I, that's the parent of 7-Eleven. What we're really talking about here is Couche-Tard perhaps buying 7-Eleven. Would that be a positive? Do you hope that happens?
Well, historically, they've been able to generate about more than 30% of the post-acquisition EBITDA in synergies. So that's something that I think the market is looking forward to. But right now, their bid is for the entire company. But remember that there's a lot of different parties going after 7 & I today, right? The Ito family wants to do a take private. There's companies like KKR that wants to do a buyout of some of the assets of 7 & I. And with the management buyout, potentially, there might be floating of the IPO of the North American business. We think this is the actual part of the business that Couche-Tard really wants. And there's different ways to maneuver. If they can get their hands on the North American business as is, through an IPO or a deal done with 7 & 9, the Ito family, I think that would be the best approach. Okay,
lots to look forward to in 2025. Lots of news we expect in 2025 on that one. Another stock you like is Ferrari, ticker symbol RACE, R-A-C-E.
That's right. So I think the thing to understand about Ferrari is the Pareto curve of the luxury market that it operates in. So maybe contrary to popular belief, if we think about the biggest spenders within the luxury market, they actually make up a relatively small piece of the luxury markets. But at the same time, these are the pockets that's growing the fastest. So Ferrari, if we think about it, one of the best brands within luxury, right? It's got an order book of more than 2 years going in. And so when we look at 2023, most of the purchases was done by people who already own Ferraris. So they operate in the best parts of the luxury market. So we think they can continue to grow and take price for a very, very long time.
Not a big dividend payer, correct?
No, it's under 1%.
Okay, and the next one is Aramark. This is a company that is a big caterer in commercial buildings, including sports stadiums.
That's right. Think of them as cafeterias in business buildings or in hospitals, in schools. So what's happened since COVID was it's basically a perfect storm for this business, right? People started working from home. You saw food inflation going up. And so margins are compressed for this business for a while. At the same time, they were heavily levered. So people in Frank, they weren't interested in this business over the past 1 year, 2 years. But at the same time, the company continues to deliver, continues to increase margins. And we think the margin trajectory and the debt pay down will continue going into next year. And we continue to like the company.
Oliver, thanks for coming in.
Thank you very much.
Oliver Shao, Director and Portfolio Manager at Global Dividend at IA Global Asset Management.